For many American households, the pressure is no longer coming from a single bill. It is coming from the narrow space between income, spending, savings, and credit. The grocery bill is still there. The rent or mortgage is still there. The electric bill is still there. So are the car repair, the insurance payment, the medical cost, and the credit card balance. Each expense may look separate on paper, but together, they point to a broader financial pattern. One that is quietly reshaping how millions of Americans manage their money each month. This is not a story about every American household being in financial crisis. The verified data does not support that conclusion. The more accurate story is narrower, but still significant. American consumers are still spending, yet the cushion beneath that spending appears thinner. Savings are providing less breathing room. Credit is carrying more weight. And for households already stretched by rent, food, gasoline, electricity, medical costs, and debt payments, the margin for error has become smaller. In April 2026, the Bureau of Economic Analysis reported that personal consumption expenditures rose by $111 billion, up 0.5%. In aggregate, Americans continue to spend. But in the same month, disposable personal income fell by nearly $20 billion, down 0.1%. That combination matters. When spending rises while disposable income falls, the difference has to come from somewhere. It may come from existing savings. It may come from saving less. It may come from credit. It may come from delaying other payments. Or it may come from several of these at once. In April 2026, the personal saving rate was 2.6%. That number does not mean every household has no savings. It does not measure the total cash sitting in people's bank accounts. What it measures is how much disposable income is being set aside during a given period. As a signal, however, it matters. A low saving rate means that, at the aggregate level, the distance between income and spending is narrow. For ordinary households, that distance is where financial stability lives. It is the space that covers a sudden car repair. It is what absorbs a medical bill. It is what keeps groceries, utilities, or rent from moving onto a credit card. When that space shrinks, spending does not always stop immediately. Households keep going, but they reach for the next available tool. Increasingly, that tool appears to be credit. Federal Reserve data for April 2026 showed total consumer credit rising at a 4.8% seasonally adjusted annual rate. More telling for this story, revolving credit, the kind that includes credit card balances, rose at a 10.4% annual rate. That does not prove that every new dollar of revolving credit reflects financial distress. Some people use cards for rewards. Some balances reflect timing. Some borrowing is entirely manageable. But the broader picture is hard to ignore. Spending was up. Disposable income was down. The saving rate was low, and revolving credit was accelerating. Taken together, the data suggests that credit is helping fill the gap between what households earn and what they spend. And that gap can become very expensive. In the first quarter of 2026, the Federal Reserve reported that the average commercial bank credit card interest rate was 21% for all accounts. For accounts actually assessed interest, meaning accounts carrying a balance, the rate was 21.52%. That matters because a credit card can feel like relief when the bill first arrives. But if the balance is carried, the cost does not end with the original purchase. A grocery bill becomes a debt balance. A car repair becomes a monthly obligation. A utility shortfall turns into an interest-bearing cost. The household has not escaped the expense. It has moved the expense into the future, with interest attached. That is the hidden system behind this story. Income comes in. Essential costs go out. Whatever remains becomes the savings buffer. Then, ordinary life interrupts the plan. A car breaks down. A medical expense arrives. Rent becomes harder to manage. A utility bill runs higher than expected. A grocery trip takes more of the paycheck than it used to. If the savings buffer is strong, the household absorbs the shock. If the buffer is weak, the household needs a bridge. That bridge may be a credit card, a personal loan, help from family, a delayed payment, a cutback somewhere else. The Federal Reserve's 2025 Household Survey, published in May 2026, shows how many Americans are living close to that edge. The survey found that 63% of adults could cover a $400 emergency expense using cash, savings, or a credit card they would pay off at the next statement. That is the majority. But it also means 37% could not cover that same $400 expense using any of those methods. And 12% said they could not cover a $400 emergency by any means at the time. A $400 emergency is not abstract. It may be a car repair, a medical bill, a broken appliance, the kind of expense that cannot wait for a more convenient month. The same survey found that 59% of adults faced at least one major unexpected expense in the prior 12 months. The most common categories were vehicle repair, home or appliance repair, and medical costs. That means the savings buffer is not theoretical. It is tested regularly, in real life. A household may look stable until the car needs work. A family may be managing the budget until a medical bill arrives in the same week as rent. When the margin is small, one unexpected expense can turn a balanced month into a credit card month. The pressure is not evenly distributed. The Federal Reserve survey found that 55% of adults had a rainy day fund covering 3 months of expenses. But 30% could not cover 3 months of expenses by any means. Both facts matter. Many households remain financially resilient. Many others are still working, still spending, still paying bills, but with far less room to absorb disruption. That is why this is not a story about universal collapse. It is a split consumer story. The New York Fed's household debt data adds another dimension. In the first quarter of 2026, total household debt stood at $18.794 trillion. Credit card balances were $1.252 trillion, down $25 billion from the prior quarter, which is a meaningful detail. The data does not show card debt rising in a straight line without interruption. But balances were still up $70 billion from a year earlier. That yearly comparison matters. The New York Fed also reported that 4.8% of outstanding debt was in some stage of delinquency. Credit card flow into serious delinquency was 7.1%. The New York Fed described delinquency transition rates as mostly steady, not collapsing, but not easing either. This is not verified evidence of a broad debt crisis. It is evidence of sustained pressure in parts of the household credit system. For a household carrying a balance at an interest rate above 21%, the problem is not only the amount owed. It is the cost of staying in that position while new expenses keep arriving. A household can make the minimum payment every month and still feel no closer to getting ahead. That is one reason the middle-class squeeze can be difficult to read from headline data alone. On paper, spending looks strong. People are still buying food, still filling up the car, still paying for housing and utilities, still going to work. But strong spending does not always mean strong finances. Sometimes it means necessities are more expensive. Sometimes it means savings are being drawn down. Sometimes it means credit is filling the gap. The inflation data helps explain why households may feel this pressure even while employed. In April 2026, the Consumer Price Index was up 3.8% from a year earlier. Food at home was up 2.9%. Gasoline was up 28.4%. Electricity was up 6.1%. Shelter was up 3.3%. These are not abstractions. They are recurring bills inside a household budget. Food, fuel, electricity, and housing are not optional for most families. When these costs rise, they reduce what is left after each paycheck, regardless of whether the job is still there. The labor market adds important context here, and it requires careful handling. In May 2026, the Bureau of Labor Statistics reported that non-farm payroll employment rose by 172,000. The unemployment rate was 4.3%. Average hourly earnings were up 3.4% from a year earlier. Those numbers do not support a story about a collapsing labor market, but they do not erase household pressure either. The same report showed that long-term unemployed individuals totaled 2.0 million, up $524,000 from a year earlier. The more accurate picture is mixed. The economy is still adding jobs. Wages are still rising on average. But some workers are facing longer job searches, and many households are managing costs that absorb income quickly, even when that income is steady. For renters, the pressure can be especially direct. The Federal Reserve Survey found that 23% of renters had been behind on rent at some point in the past year. Rent is often the largest monthly expense. Falling behind on it does not happen easily. It usually means the household has already exhausted easier options. Among adults ages 18 to 29, 47% received financial help from someone outside their household to cover an expense in the prior 12 months. That does not mean every younger adult is in financial trouble. But it does suggest that family support and outside assistance are now a structural part of the financial picture for a significant share of younger households. There is also an important backdrop from the pandemic period. Federal Reserve researchers estimated that American households accumulated roughly $2.3 trillion in excess savings during that time. Later analysis from the San Francisco Fed estimated those aggregate excess savings had been fully depleted by March 2024. That estimate should be handled carefully. It is model-based, not a precise account of what each household holds today. But as context, it helps explain how consumer spending remained resilient even as prices rose. For a time, many households had an extra financial cushion. Now, the evidence suggests that cushion is thinner at the aggregate level. This is not the same experience for everyone. Higher-income households may still hold meaningful savings, investments, and home equity. Lower and middle-income households often have less room to adjust when costs increase. That is why averages can obscure the lived reality. The official data can show consumers are still spending. A household may still be spending because the expenses are unavoidable. The official data can show debt is mostly steady. A household may still be carrying a balance that is not going down. The official data can show employment is growing. A worker may still have little left after rent, food, gasoline, utilities, and debt payments. All of these can be true at the same time. That is the quiet nature of this pressure. It does not always arrive as one dramatic event. It appears in smaller decisions. Pay the card minimum instead of the full balance. Delay a repair. Use savings for groceries. Put a utility bill on a card. Ask for help. Postpone something because the month is already too tight. The verified data does not tell us exactly what every household is doing, but it does show the conditions that make those choices more likely. Spending rose while disposable income fell. The saving rate was 2.6%. Revolving credit grew at a 10.4% annual rate. Credit card interest rates for accounts assessed interest exceeded 21%. Card balances were higher than a year earlier. More than 1/3 of adults could not cover a $400 emergency using cash-equivalent methods. And more than half of adults had a major unexpected expense in the prior 12 months. These are not assumptions. They are signals from official data. The current picture is this. Many Americans are still participating in the economy, but the financial foundation beneath that participation appears less stable than it did a few years ago. The story is not simply that people are spending too much. It is that essential costs, uneven savings, high credit costs, unexpected expenses, and household debt are interacting inside the same monthly budget at the same time. For ordinary Americans, the risk is not always immediate. It is often gradual. A little less saved this month, a little more on the card, a balance that carries over, a repair that arrives before the next paycheck, a rent payment that becomes harder to manage, a medical cost that quietly becomes debt. That is how a savings buffer fades. Not always in one moment. Usually through a sequence of ordinary bills. What remains uncertain is whether this becomes a deeper credit stress story or remains a manageable household cash flow squeeze. That depends on the next round of data. Income, inflation, employment, revolving credit, delinquency rates, and household debt. But the pressure already visible in the data is real. The American consumer is still spending. The labor market is still adding jobs. Many households are still doing at least okay. Beneath those headline facts, the margin is thinner for many people. And when the savings buffer is thin, credit becomes more than a financial tool. It becomes the bridge between the paycheck and the cost of daily life.